Okay, welcome everybody to episode 60 of the Volatility Barometer. So first of all, definitely apologies. It's been sorry, forgot to turn off YouTube. I was saying it's been a few weeks, several weeks to be honest, since we've done the live streams, but we're back. We're in content mode. I'm by myself here in Dubai for a couple of months, so I will definitely have some more time to focus on live streams and videos. And one thing that I do want to say, though, today, just a fair warning, I will be squirming in my chair here. I was in the gym, and for some reason, I really hurt my back. I can barely breathe, to be honest. I'm in a lot of pain, but I said I would do this, so I'm going to tough it out. So one thing that I want to show before we get started is I just want to review a few of the videos that I've made recently, just in case you missed the content. I think there's some that, of course, volatility traders will be very interested in. So since the last stream, I think we left off here. So this whole thing is a running video series. This first video, what we did is we calculated when the VXX will basically dip below $25. We used the long-term decay factor and we crunched the numbers and we calculated that. And then in the follow-up video, I executed 5 live short VXX trades, all different methods. So we had basically short the ETF, we have long put option, long vertical, long butterfly, and a naked short straddle. Basically 5 very different methods of shorting volatility. And then video 3, I compared the pros and cons of all of those. You know, not every strategy is all negative, no positive. They've all kind of got trade-offs. So check out those 3 videos for sure. And there's 2 more coming, probably next week and the week after. I've got a couple interesting ones comparing some of those trades and massive discrepancy on how they have actually performed in this epic volatility crush that we are seeing. And then this one, of course, for volatility traders, this is one showing the VXX performance in different VIX ranges. So if you're one of those more volatility targeting type people and you want to know, hey, if the VIX is 16 or if it's, 16 to 20 range, what's the performance of VXX in that range? You can check out that video there. And then this one I definitely want to highlight. This is a video introducing the Iron Condor course. Now, if you're new to my live streams, you may not be aware, but we do run a private community. Now, no pressure. My live streams are free and don't super chat, don't send me any money. But I do want to highlight the fact that we do actually have a 30 video mega course for Iron Condors within the VTS community. So you can see here, all of these are individual videos that they basically break down a specific aspect of an Iron Condor strategy. You know, why longer dated contracts are better, why we like wider wings, isolating which volatility levels. You get the point. There's a very extensive course here. And it is available to anybody who just subscribes to the service. So there is a free trial, of course, no obligation. You don't actually have to pay money for that course. You could just sign up for the free trial on my website and then dive into the course immediately. You'll get access to it on the first day. So just wanted to bring that to your attention in case you're not aware. If you are an Iron Condor trader or you do want a strategy that can basically plug that hole, a lot of traders, of course, they have plenty in their portfolio that will do well when stocks go up. But not many people have stuff that can do well when stocks are flat or going down. So check that out for sure. You're invited, no obligation, of course. Like I said, my live streams are free. Ask your questions and we will get into this. Let me see if I can get in a position here where my back is not going to be completely throbbing and interfering with my breathing. So you can see the rundown there. Sorry, I probably look a little stupid. If I concave my back, it actually feels pretty good. So we're going to run through, of course, the UVXY Reverse Split stuff. I'm going to get into all of, what that entails, how it affects the options and all that. And then this is where I might have to call an audible. If my back is okay, then I'll dive into the second segment. If it's not, and I feel like I want to bail, then we'll jump into the Q&A and I'll answer a bunch of questions. And then I'll go lay down on my back and probably crash for the night. So with all that being said, let's dive into this news of the UVXY Reverse Split. So of course, we have been waiting an enormous amount of time for this to happen. And this is the longest we've ever seen the UVXY and the lowest price we've ever actually seen it go before they reverse split this thing. You can see it's at 216 right now. This is pretty crazy. So what we are going to do, let me open up that little This is just for my notes, basically, to keep my brain organized here so I can go through it. So they did finally announce that the reverse split will be happening June 23rd, which is next Friday. So be aware of that. It's going to be a 1-to-10 reverse split. So the first thing that we're going to do, and of course, if you're a long-term volatility trader, a few of these things, you'll already know them. But some of you, this might be your first go on a reverse split and you're a little bit concerned. What does it all mean? So I'm going to break down everything. And for people who know this stuff, not a bad thing to review. So the UVXY reverse split history. This is something that we need to look at because, of course, oh, I don't have my right spreadsheet open. That is a problem. You can tell I haven't been live streaming for a while. Which one do I want to open? Let's open that one. Yeah, basically the UVXY reverse split history. We can see here that this is going to be number 11. So this thing splits often. This is not overly uncommon, but this is clearly going to be the lowest price. So the average for the previous 10, it averages to about 713. And this one is happening, of course, at 220. So crazy. I don't know what happened internally that made them wait this long. I suspect something, I don't know, some type of filings. Maybe they were waiting because they were splitting a couple other of their ETFs. Maybe they all, for some reason, wanted them on the same days. I don't really know what's happening, but basically it's going to happen at a price low twos-ish, which probably means that, look, if the market maintains its course, we're probably going to see a reverse split pretty soon after this as well. I suspect it won't be very long before we're going to actually need another one of these. So, but the big question is, why do volatility ETFs reverse split? Again, you might be aware of this, but just in case you are not, this is what the UVXY looks like. Now, I've adjusted this to 1.5 times leverage. You got to remember that in February 27th, 2018, they deleveraged it from 2 times to 1.5. And then this is showing 1.5 all the way back. So the decay factor, of course, for the first 6 years was at 2 times. So it was actually a little bit more than this. But you can see all the splits happening. Now, why is this happening? Well, essentially, these products are acting as insurance products. So what is happening is the number of people who are buying and selling the ETF itself is not what's causing the price to change. Of course, when you're talking about ETFs or, any type of stock or anything, you've got Apple stock, the buying and selling action of the underlying security is what's causing the price changing. But you have to just view volatility products as an entirely different animal. That's not what's happening. It's not actually a supply and demand thing. What is actually happening is these things are tracking underlying methodologies, an underlying index. So this one here, this is called the SPVIX STR. This one here is essentially what the VXX looks like. VXX tracks this, front 2 months of the VIX futures. The UVXY being a leveraged product, it tracks basically this exact thing, just at a 1.5 times leverage factor. And the methodology is pretty simple. What's happening, this is the VIX futures term structure. All of these are VIX futures going out in time. So the front month, this is expiring quite soon. And then 1 month after that. The volatility ETPs like UVXY only trade the front 2 month futures. None of the other ones matter. So essentially what they are doing on the very first day of the new cycle, they are holding 100% of this future and 0% of the back future. And then every day that goes by, cycles are typically anywhere from something around 18 days if there's a shortened month with a holiday, and it could be as long as 25 trading days in the cycle. But essentially each day that passes, they're selling a little bit of this front month and they're buying a little bit of this back month. Now that in of itself, this is oftentimes a point of contention with people that don't quite understand it. That's not, again, what's happening with the price changes. There is no buy low, buy high, sell low dynamic going on here. The contango actually is irrelevant as well. That's not what's causing the price changing. But what happens is they sell a little bit of this one, they buy a little bit of this one, and as the cycle goes by, it moves towards a more heavy weighting on the second month. And then expiration happens, this one dips off the board, this one becomes the front month, and we do the whole thing again. So you can see if you highlight here, it says there's 4 days left, which means we're getting awfully close to the end of this cycle. In 4 days, right now, The UVXY is holding mostly the second month VIX future and not a whole lot of the front month future. 4 days from now, next Tuesday, or actually technically next Wednesday morning, this is going to drop off the board. They will be holding 100% of the front month, 0% of this one, and the whole cycle starts again. But what's actually causing the price changes with UVXY is this front month VIX future on expiration will be the same price as this VIX index. This is the spot VIX index, currently at 1374. That's really all we know. There is no causation here. Of course, the VIX is calculated off the S&P 500 options, and the VIX futures are a freely traded market. It's not like one is pulling the other one in any specific direction. These are independent of one another, but we know that on expiration day, these are going to be the same price. So if these two futures are above the VIX index, we call that roll yield, right? There's essentially a positive roll yield there where, all else being equal, if the market tomorrow is exactly like it is today and everything is normal, basically there's going to be a headwind for the UVXY and it will drop in price. Probably, as of right now, about 1% a day, because there's pretty significant roll yield right now. But that's actually what's happening, is that this entire curve, all else being equal, when it is in positive roll yield territory, it will be dropping down a little bit each day. And that's what's causing the UVXY to change price. It's not that this one is cheaper than this one. That has nothing to do with it. You'll even see volatility, in air quotes, you can't see me, but experts who actually think that that's what's happening. But that's not what's happening. It's actually just that the front 2 months that they are holding, the value of those futures are decaying whenever this is the case. Now, you might ask, well, how often is that? Well, this is why the UVXY looks so diabolical, because it actually is quite common. So we can see here, this is the VX30 to VIX roll yield, going all the way back to the launch of VIX futures in 2004. The average level, the median 50th percentile, at 8.2%, which means there is a pretty strong headwind for the UVXY fairly consistently over time. 82% of the time, this thing has the roll yield that will be decaying the UVXY. That's why the UVXY decays long term. And that's why it looks like this. Because 82% of the time, those futures, market held equal, no changes day to day, there is a headwind and it's just going to be eating away at that value. Now, a lot of people think, oh, well, that sounds manipulated. That's crazy. They're just basically designing this thing to go down. Again, I would say that's an inaccurate way of viewing it. The best way to view this is as an insurance product. If you imagine your car insurance, your house insurance, fire insurance, any type of insurance that you carry, that's what's happening as well. You are basically paying a premium up front, and that money is bleeding down, and there is an expectation that every month you are going to be losing money. But on the backside, there might actually be a payout. And in the case of the UVXY, we know that 82% of the time, the roll yield is positive and it's going to be decaying downward. As I always say, everybody and their dog already knows this. There's no edge to knowing that anymore. The entire market knows this at this point. But some traders are on the side of the short vol trade. So what they're trying to do is capitalize on the fact that 82% of the time it's going down. They're trying to sidestep those big volatility spikes, right? Design a system that doesn't take on too much risk. There are people on the other side of the trade that think, okay, well, this is a good deal. I'm paying for the insurance. And oftentimes this thing is going to double or triple, or, in the case of the COVID crash, 1,500% spike. So that's what's happening. You can see the UVXY. This is a price from, 14 to 28, basically. That's a double. This thing is from 11 to 23. That's a double. Double price, double, double, double. That's what happens with this product. Most of the time it goes down. Some of the times it rips your face off. That's an insurance product. That is exactly what it would look like. So if you were to plot a hedge on the S&P 500, an out of the money put option, for example, it would look very similar to this. Your home insurance would look like this if you were able to plot it on a chart. Now, you probably wouldn't get that many break-ins or fires, but you get the point. So that's actually what's happening. That's why this thing has to constantly reverse split, because of course 82% of the time it's going down, and that is not good for the long-term long-term price. But nothing diabolical there. It's not manipulated. Nobody's trying to steal your money. You can choose which side of the trade you're on, and you can structure your trades to, benefit you as best you want. So How does a reverse split work? This is actually really simple. I'm sure it might be your first experience with a reverse split. That's fine. But if you were to imagine a regular stock, we don't call that a reverse split. We call it a split, right? So if, let's say, a stock is at 1,000 and it's becoming difficult to trade, well, what's going to happen is they're going to do a split. They basically divide, they reduce the price significantly. Let's say a 10 to 1 goes from 1,000 to 0 transaction. That's a split. A reverse split, same thing. Nothing changes hands. No value is lost. Your net liquidation value is preserved through the split before and after. It's exactly the same. The UVXY is at, let's say, $2 by the time it happens next Friday. They're just going to take it to $20. So the price goes up 10 times. The share count goes down 10 times and nothing happened, right? It's going to come and go like nothing happened, of course. The only thing that you might want to be aware of, let's say you had 101 shares, right? They're going to divide that by 10 and you're going to have 10.1 shares. You can't have 0.1 shares of UVXY. So what they're going to do in that case is they will cash settle that 0.1. So you're going to wake up the next day. If you had 101 long UVXY shares, I mean, obviously pour out a little liquor for that trade. It's been pretty awful for you recently. I hope nobody's long UVXY. But if you had 101 shares, you'd wake up with exactly 10, and then you'd have a little bit of additional cash balance in your account. But again, no value will be lost. It's very basic. A lot of people freak out when there's splits. They think, they're going to get robbed money. And no doubt, if you go on Twitter, you will see people talking about how, oh my God, UVXY, look at the price. I mean, I made a fortune. This is what people are going to be tweeting the next day. I promise you. You're going to be people talking about how they made 1,000% on their trades. Nope. It's just, it comes and goes like nothing happened. Now, how does it affect options? Well, roughly the same. In general, it is the exact same principle that with options, they don't quite split it the same way. But fortunately, and remember I showed you that chart of the reverse splits here, fortunately the VXX did a reverse split about 3 months ago. So we can actually use that and we can visually see what's going to happen. Let me get rid of some of these windows. Oh, there's our social media fails lined up for the next one. So what's ended up happening, if you look at VXX, because, there's clearinghouses and options are a little bit different, it gets a little bit messy if you're dividing contracts and doing all that. So what they're going to do instead is they're just going to introduce a new option string for the new options. And then the old ones will just remain the same. So if you look at VXX here, it was a 1-to-4 reverse split. If you look down this page, you'll notice this one says 25 over 100. If we go into this one, look at the prices here, 5, 6, 7, 8. These are very low prices. The VXX is trading at 27. That doesn't make any sense. But you remember, this is a 4-to-1 reverse split. So this one that says 25 over 100, these are the old options for the old pricing. And they remain open until that expiration cycle is finished. But the new one, this one that says 100, these are options that the market makers created after the reverse split, representing the new prices. 26, 27, 28. That lines up perfectly with today's value. So when you go into the UVXY the following Monday, so 10 days from now, all of these hundreds will actually visually say 10 over 100. And that's how you're going to know that these are the ones that represent the old pricing. This will not change. So it'll still say 1.5, 2, 2.5. But then, couple days into it, Tuesday or Wednesday, you're going to start to see new option strings form. And those are the ones that are going to say 100. So obviously, those are the ones you're going to want to focus on. Now, again, nothing technically changes. You don't lose any value if you've got options open. Nothing's going to happen to your capital. Nobody's going to rob you of any value. However, best practices, it is a good idea to close any options that are using the current pricing and then just reestablish a new position when the market makers do that. Because technically speaking, your value is going to be the same, but you might run into a problem when you're closing out your trades. Your exit liquidity might dry up pretty fast, especially if you stretch it out too far after the reverse split. So what I always say is just best practices, close out any UVXY option trades you have, either today, if you've got time, maybe next week, up until the reverse split is fine, and then just reestablish the position. And one other thing, of course, I should mention, every single option structure, trade, hypothesis you have, can be equally executed on VXX or UVXY. There is just a leverage difference, 1 to 1.5. So the VXX has been trading for 3 months after its split. It's trading perfectly fine, good volume, everything's great. There would be nothing wrong with you just skipping UVXY for a couple of weeks, going to the VXX, and then in a couple of weeks when all of those options are cleared again, look for the ones that say 100 and go ahead and trade UVXY if that's your preferred one. But actually, it's all kind of the same. It doesn't really matter. So you're going to be closing out those options. And then the last thing I will say here really quickly is next week, we will, after the reverse split, we'll do another podcast where we get into predicting the next reverse split. And like I said, I suspect that one won't actually take very long. But if you want to see, we're going to use the decay factors, of course, calculate basically where everything is going to be. We've got a little calculator here, and we can predict the very next reverse split day. And last time we nailed it really closely, like within, I think it was 11 days or something. So we did the VXX a little while back. That one is expected to reverse split again on May 16th, 2025. We will fill in the UVXY with the new split. So it's not an exact science, but you do learn a little bit in the process along the way. So that is all really we have to say about reverse splits. It's a very simple process. Like I said, don't freak out. You're not going to lose any of your money. It's just something that has to happen because, of course, you've seen the decay factor of UVXY. So there's a bunch of questions here. Let me make a call here. I'm hurting. My back's killing me, but let's keep going. Let's do segment 2. Let's do the social media fails. So what we like to do is we like to scour TikTok, and sometimes people send me things that are kind of funny. And I'm not doing this to make fun of people, of course, but we need something as a backdrop. So obviously, here we go. We're going to listen to what this future up-and-coming superstar investor has to say.
Just how to make $1 million or more with very little effort. Whenever you go to a hotel, get a bunch of free soap instead of buying it from a store. This will save you on average $45 a month. Then if you invest that into the S&P 500, you're estimated to have over $1 million by retirement. Just how to...
Okay. Short and sweet, to the point. So again, I don't want to hack on the kid. I respect the hustle. I just can't even imagine if I was that age. And there's a lot of things you can do on TikTok, and he, at his age, has decided to do finance content, so that's good. There are a few holes. I have a few questions, such as who is paying for the hotels, but, I'm sure dad's eating that cost, and, it's not really factored in. So that was the point. Like, you save $45 every month by, stealing soap. It seems to be an enormous amount of soap to me. I don't know who spends $45 a month on soap, but I guess somebody does. But you see a lot of these on TikTok. Of course, it's everywhere. You do this, you stop drinking Starbucks. You can retire a millionaire and you save $50 here. It's easy, right? You just do that and you retire a millionaire. So we like to scrutinize this because investing is a serious game. I mean, you have to actually know real numbers. You can't just throw things out there like that, like saving $45 a month somehow makes you a millionaire. Let's, first of all, do what we always do in these situations. Let's go ahead and see how close to that $1 million he actually is. So this is a compound interest calculator. Start at 0, of course, and you're 20 years old. You're going to invest for 50 years. Remember, the kid said that, you get 50 years to do this. I'm going to give him an 8% annual return. That seems ambitious for a buy and hold. I'll get into that in a second, or I can even actually show you now. I mean, even the S&P 500, a lot of people still use that tired old, the S&P returns 10%. Yeah, not since World War I, basically. What numbers do you want to use? Like, let's not cherry pick too much. Let's go 25 years, so 1998, and adjust for inflation. The S&P has brought in 4.7% in the last 25 years, inflation adjusted. If you want to see without inflation, 7.4 basically. So this 10% number that everybody throws out there, it's ridiculous. That's for our great-grandparents' age. You don't do that. Basically, I don't even know how far this calculator goes, but those 10% numbers are typically some insane time frame. Let's check from 1871 to 2023. 6.8. I don't know what we need to do to get this to say 10, But it's unbelievable to me that everybody on Twitter and TikTok, they still quote that 10% number for some reason. Financial advisors do it as well. I have no idea why. I don't know where it's coming from. In our entire investing lifetime, the S&P has not returned that. But anyway, here you go. So I'm going to give them 8. Going to pay no taxes whatsoever. We're going to save $45 a month because we don't have to buy our own soap. And the long-term inflation rate, this is just a rolling 50-year average. That's just what it has been. I suspect it's going to be significantly higher than that going forward, but we'll just use that. And the truth is, you won't have $1 million. You'll actually have $84,500. So no big surprise here. $45 a month is not really going to put a dent in your retirement savings. I don't know what astronomical rate of return he was using to come up with $1 million, but the truth is, it is, substantially less than what he was saying. But the point is, he did say one thing that is excellent, and that is starting young. So I want to turn this little, again, not hacking on the kid. I respect him for doing the videos, but we have to turn it into something meaningful. So a lot of times people don't actually understand how important it is to start investing at a younger age, even if it is smaller dollar amounts. They've been told that, but to actually see it with numbers compounding over time, I want to show you what the difference is between different time frames, and you might actually be surprised. Hopefully what it makes you do is immediately this month, you will start saving more money, because every month, every year that you waste, time is one of our most valuable assets when we are investing, and we don't want to waste that. So I am actually going to calculate how you reach $1 million. So what this is essentially showing is start with 0, you get the 8% return. Again, a little ambitious, but let me default to the high end here. 3.85% inflation is probably too low, but let me again be super generous. How much do you need to get to 1 million? So it turns out it's not $45, it's actually $545. So he was off by, a magnitude of 10 times. But anyway, if you invest for 50 years and you save $545 per month, you will retire a millionaire. So that's kind of the number. It's a very low bar. I don't want to say very low bar. Everybody's in a different situation, but saving $545 a month, hopefully people are doing that, right? This column over here is just showing how much of that money is actually yours that you deposited and how much came from investing activity. So in this case, 32% of that money, the $1 million that you retire with, actually came from the money you deposited, the 545 over 50 years. But what if you wait 10 years? What if you only invest for 40 years? Well, now you have to put $870 per month, which seems like a very manageable level still, but that's a pretty significant jump. Losing 10 years is actually going to cost people, and it's going to mean that you have to be more diligent with your savings. Your income has to be a little bit higher, and 42% of the money is yours. You're essentially just saving 42% of it. So it's not actually compounding for 50 years, it's only 40. Well, now, what about 30 years? Well, now this is a pretty significant jump, right? Now you need to deposit $1,470 a month in order to retire a millionaire if you want to invest for 30 years at that rate of return. Now, 30 years, I feel like this is a fairly reasonable number because very few people are able to start investing when they're 20 years old. If you can, that's awesome, but very few people can. Earlier on in our lives, a lot of people have expenses. You graduate university, let's say 23, 24 years old, you might have student loans that you're paying off for 10 years. You buy your first house sometime in the first 15 years and you save for a long time to get that, and then you dump that lump sum into a house. Probably you got married, or hopefully you got married, your wife probably wants a ring, she wants a wedding, so you're going to have expenses there. You might have a couple of kids. The point is, most people make it to about age 40 and they realize they haven't really started investing yet. So they've got age 40 to 70 on a more realistic time frame. Obviously 20 to 70 would be fantastic, but I know I wasn't in a position. I was a broke professional golfer for, I had no money until I was 36 years old. I was basically broke because I was spending my time trying to make the PGA Tour and I didn't quite make it. So I found myself in my mid 30s with, zero investing no net worth, basically. I think I had $60,000 when I retired from golf or something. So that's a pretty standard situation for people. Most people will start when they're 40. So if you do that, well, now you actually need a significant amount of money, right? $1,470 a month, that's a lot of money. What if you wait 10 more years? Well, now it starts to get pretty serious. Now you're really up against it. And now the only way to do this is through a higher income. You can't save your way to $2,770 per month. That's just too much money. And again, now you're at a situation where 66% of that money was your own money. You're just stuffing it in a mattress, right? Only 34% of this money is from compounded investments. So now you're losing all that time. Well, I don't mean to paint too grim a picture here, but what if you only have 10 years? What if you have no money right now, but you know how to make an 8% return, and you want to be a millionaire in 10 years? Now, side note, a lot of these people on Twitter, and I love bashing these people because they're absolute liars. If you've been on Twitter lately and you notice a massive uptick in the number of people who will say, I retired a millionaire at age 33, or I retired a millionaire at age 30, and then you dig into their account a little bit, and they'll always say they did it through index fund investing, right? Oh, I just did all the right things. I didn't go to Starbucks. I didn't do this. I drive a Toyota Corolla, a 10-year-old car, and I just stuffed my money in an index fund. You know these people are lying through their teeth, right? I mean, that is just not possible. And I'm going to show you why you cannot retire in 10 years off not going to Starbucks and driving a Toyota Corolla. It doesn't work that way. You need an astronomical income to be able to do that. So where's my presentation? What number do you think it is? If these people on Twitter are actually telling the truth, that index fund investing, which, as I showed, doesn't even make the 8%, the number is $6,850 a month. That's how much you have to save. Remember, that's after taxes, and that's after all your expenses. You need a pretty good income. You're talking about a top 10% income in the United States and living just absolute poorhouse type style living. So this is why I always laugh at those people that say I retired at 33 by investing in index funds. No, you didn't. Stop it. You're just getting people to sign up for your stupid newsletter. That's what's happening. But if you wait only 10 years, now you're really up against it, and it really can only come from a very high income. So I don't know if people have actually seen this before. That's why I wanted to go through it, that yes, time is our most valuable asset. Now, another thing I'll just mention really quickly, if you want to retire an actual millionaire, not one of these people on Twitter who clearly have not done even basic grade 10 math classes to know that what they're saying is not true, but if you want to retire a real millionaire, this is how I would recommend it. It is doable. You know, obviously it's possible. It's actually quite simple. It's just not very easy. Number one, build up a stable and growing income. The reason why I say and growing, there's two reasons for that. First of all, as we know, inflation, right? For some reason, all of these TikTokers never adjust their numbers for inflation. They think that the $1 million today is going to be the same million 30 years from now, and it's just not. So the rolling 50-year inflation rate in the United States is 3.8%. And this is just a prediction, this is just a guess, but I suspect it will be higher than that going forward. So you always have to inflation adjust everything. So you need an income that is not only stable and good, so you can save a bunch of money, but you also need your income to be growing and outpacing inflation. The second reason that you want to have a growing income is, where's my spreadsheet here? Did I close my spreadsheet? Where is that? I don't know why I did that. Okay, I lost my train of thought here. What was I saying? There's nobody here to remind me. Build up a stable and growing income. I was talking about something along those lines. Give me 1 second here. That derailed my thought process. What I was going to say, sorry about that. I'm actually more concerned about my back. It's totally throbbing here. The reason that you want to do that is, of course, that... Wow, I just forgot what I was going to say again. I need a reminder here. I'm struggling. I can barely breathe because my back is just absolutely killing me. I don't want to cut the live stream short, though. I said I would do this, and I said I would hang out for all the questions. I'm going to keep going. I'm going to keep pushing through this. So anyway, you can't actually save your way to retirement. It's, there's always going to be a limit on how much money you can save. You can reduce your expenses and you can drive your 10-year-old Corolla, but we do want to live life a little bit. We want to enjoy ourselves. And so there is a limit to how much you can actually move the goalposts by savings. But income, there really isn't a cap to how much income you have. So as long as you're growing your income and it's consistent over time, you should be fine. That's really what you want to do. Too many people focus on cutting expenses. Not enough people are focusing on telling people that, try to start a side business, a side hustle. $1,000 a month would go a long way. And you never know, maybe it leads to $3,000-$4,000 a month, and that's your savings, right? So you definitely want to have that consistent growing income. That would be number one. You want to outpace inflation, and nobody wants to have to live the bare bones lifestyle. We got to live a little bit, right? The second thing you want to do, of course, is reduce your expenses. But more than that, you just want to focus on not suffering from what's called lifestyle creep, right? What ends up happening is the more money people make, typically the more money they start to spend, right? You'll get into a situation where you see people who make 50 grand a year, maybe they're saving $500 a month. That would be great. And then somehow over time, they're making $100,000 a year. They're really not saving any more money than they were before, right? Maybe they even bump it up to $250,000. There are people out there that make $250,000 a year that struggle to save $1,000 or $2,000 a month. I mean, it really does happen. So you really want to avoid lifestyle creep. There's always a nicer home. There's always a more expensive restaurant. There's always a cool car or a little toy. There's more expensive wines. Your watches, you go from your Seikos to your, whatever you want, your Rolex. There's always a next level. So what you want to actually do is be comfortable with just living your life. Always live below your means and don't suffer from lifestyle creep. And the third thing, of course, invest wisely with a long-term mindset of beating the market. I already pointed out, don't listen to people that are going to tell you that stuffing your money in index funds is going to make you 10% a year. It is not. That's just not the reality of what's going to happen, especially starting in 2022 going forward. Again, prediction, nobody can see the future, but you can't honestly tell me that this number is going to go from 4.7 up to 10. That is totally just don't expect that. You don't want to plan your life for perfect case scenario. You want to plan your life for something that's going to realistically get you to retirement. So you can beat the market. There are ways to beat the market. I don't want to make this sound like it's a shameless plug for my business, but we've been doing it for a very long time now. And I plan, ebbs and flows and ups and downs, but over a 30, 40-year career, yeah, of course. You can make 10% a year. You can make 12% a year. That's the goal. You don't have to make 30. Anybody on Twitter who's saying, I'll make 50% a year, just ignore those people, obviously. But if you knew how much of a difference 1% makes over a 40-year investing horizon, in fact, I'll put that on the list and we'll do a data corner in one of our future live streams. I'll show you. It's significant. So don't go from the mindset of, buy and hold on the S&P. And remember, that's just the S&P. If you include bonds, it gets lower. If you include precious metals, it gets lower. That's why the average investor, they've done countless studies, the average buy and hold investor makes 2 to 3% a year. Why? Well, because they have a diversified portfolio. The best thing in their portfolio is the S&P at 4.7, but they also have diversifying assets that are much lower than 4.7. So don't shift your mindset from 4.7 to 40, right? Shift your mindset from 4.7% a year to 10% a year. Try to find a way to consistently over time, not every year, you're going to have losing years, you're going to have very big winning years, and everything in between. But 10, 12, that's the magic number. 12% a year would be phenomenal, and you will retire a millionaire. And then the last thing I do want to highlight, because I do not want to make fun of people, that kid is absolutely right. Start as young as you can. He looked to be about 16 years old, 15 years old. I'm terrible at gauging age. I'm old. Maybe he's younger or older than that. I don't really know. But yeah, start as early as you can, because as I showed, it makes a massive difference in your outlook for the future. Your rate of return needs to get higher the longer you wait. The money you have to save gets higher. The more path dependent you are on when the market performs well and when it doesn't. Over a 40-year period, you're sitting in really good shape. Drop that down to 10, 15 years, you're up against it. So hopefully people enjoyed actually seeing the numbers. Sometimes people hear things, they're like, oh yeah, of course, time. Well, how much difference? $545 to $6,700 a month. It's a huge difference. Time is one of our most valuable assets. I wish I could lay down on the floor and try to snap my back into place here. All right, I'm gonna look like a dork sitting here completely stiff, but this is the only way I can sit. So now let's get into the questions. Pretty low energy live stream today. Sorry, I'm trying to actually breathe and focus at, get this done. So I saw there was a bunch of questions before we started. This one stands out. What and when was the lowest reading of the barometer that you can recall? So I can do you one better. Of course, I can actually just show you the volatility barometer. This is, of course, for people who don't know, this is a volatility index that I created that uses many different metrics, not just one. Of course, in my daily email for the VTS community, we show every day the values for obviously the volatility barometer. It's at 31% today, but also some useful statistics on various metrics that I like to use. Some of these are in the barometer, some of them aren't. Cash VIX term structure is pretty awesome. There's a ton of information there, but the volatility barometer is something that I created. And you can see the lowest values actually were pretty consistently through 2017. That's not overly surprising. There was a few periods where it dipped low and then reversed. But remember, 2017 was the lowest volatility year record in history, basically. So the lowest level, to answer your question, was 1370. And the highest level was 9091. That was March, I want to say March 12th. March 16th was the ugly day during COVID in 2020, but I think the barometer peaked on March 12th. So it does go anywhere from, let's say, down to the low teens up until about 90. Now, one thing I can mention really quickly is that's just how I view the barometer. I could also just do a normalizing formula that makes it actually go from 0 to 100. I could do that. It's just that the way that I structure it, the way that you combine it and do all the weightings, it's very unlikely to get over about 91, and it's very unlikely to get below 13. But I have often considered, because I get a lot of questions, how come it, 2017, how come it doesn't say 0? I might normalize it, but I don't want to make any changes now because we're changing our portfolio a little bit, just minor tweaks. So maybe next January, I will adjust the barometer and make it say something, 0 to 100. This person says, new to VTS, welcome. Thank you for taking the trial. Hopefully you dove into your Iron Condor course. And yeah, waiting for the first trade. We've been in many of these positions for so long. I mean, it's not my fault. I will gladly take the money. But we are basically just riding a lot of these positions for months, right? We've been in 2 times NASDAQ, crushing it, 2 times the Dow Jones, no reason to switch out. I think we switched out of the 2 times S&P once or twice in the last couple months. But yeah, it's just been a period where we have just been riding the market, and I'm not complaining, right? I don't want to overtrade. If the market doesn't force me out of any positions, I'm more than happy to sit in 2 times equities and just take the money. So that's what's happening. I don't know when you're going to get your first trade, but hopefully it'll be pretty soon. I know for sure you'll get an Iron Condor soon because we'll probably open one either Monday or Tuesday. And you'll probably get a UVXY or VXX butterfly, maybe Tuesday, Wednesday, it's looking like ahead of time. But I don't know when you're going to get an equity trade. The market is strong and it doesn't look like it's reversing anytime soon. So, all right. I don't like the looks of this already. I'm hoping you will address this, but in my foolishness, I bought a lot of UVXY shares as well as future options. In your opinion, not financial advice. Nothing I ever say is financial advice. Although I hate when people say that, to be honest. Oh, by the way, this is not financial advice, and then they proceed to give you direct financial advice. So I don't bother with those disclaimers, whatever. Yeah, I'm talking about finance. So should I sell before the split? Well, like I explained, and I don't know, you probably asked this before I did my presentation, but bad back. Selling the shares is not necessary, but again, I'm sorry to say, but you're getting crushed on that position. So it's probably, now you're in that range where, what do you do, right? You've probably lost a significant chunk of money. And now your brain is probably telling you that, look, if I sell this now, the market's going to crash next week, right? It's just what seems to happen. I don't know why it is. I don't know if it's just me or not, but it does seem that way. So I can't tell you to sell your UVXY shares. All I can tell you is that now, and actually the last 3 or 4 months, there's no reason in the world to be long UVXY. There's just no indication in the market anywhere at all to be, since March. And maybe you could make a case there, and about the middle of March, there was volatility high enough to justify. But once it crashes down, you are essentially trying to be that contrarian that times the market. How are you going to time something that has gone from $2 billion down to $2? You're going to be the one that threads that needle and buys long UVXY shares and makes money? I don't think so. Maybe you're just a savant at trading. I don't know. I'm not trying to be critical, but buying long VXX or long UVXY is, as we showed before, certainly mathematically, it's 82% of the time. Nope, not that one. It's 82% of the time not a smart position to take because you are directly fighting against the actual methodology of the product. Remember, it's not supply and demand. This is based on a functional methodology of rolling the VIX futures. If you're long this thing, the vast majority of time, you're taking the wrong trade. It is just a mathematical certainty that you're going to lose money. So you got to thread this needle, and I don't want to be that guy that tells you to sell it now, and then next week we see this epic market collapse, and you come back to my live stream next week and you yell at me, but you're in the wrong position. I don't know what you're going to do about that. It's on you, but I would say learn more about how the products work. And the more you understand about the volatility ETPs, the less inclined you're going to be to buy the long shares. That's just what happens. I've showed my first VXX trade ever was in July 2010. So, I've been trading these things for 13 years now. My first trade was long VXX, and I very quickly veered towards short. And by August 2010, I was on the short side. I was trading short, and there's just, it's a function of understanding how it works and probabilities, right? I can actually even show that to you if you want. Let me see how quickly I can pull this up. I don't kill too much time, but I can go to my actual account in 2010, and you can actually see the first trade I ever made. It's pretty funny. I was one of the first people trading these volatility products. Been doing this forever. So where's 2010? Does it even go far that back? Wow, the cutoff is 2010. So my Ameritrade won't show it anymore. So let me go to a screen share. So you can see my account here. This is July 2010, right? And I bought 1,000 shares of VXX. So I spent 23 grand there. It looks like I doubled down. So I spent another 22 there, did some options, probably freaked out, got a little excited there. So I'm in this for $65,000 of long VXX in 2010. This is my entry to this thing. And you can see I very quickly went to just doing normal options and selling and obviously doing what I do today, right? It didn't take me very long to understand that this is dumb. Now, the funny thing is that trade actually made money. I think I made about $2,000 on that trade. But, 13 years ago, I thought the same thing. Oh, this product, it spikes up when the market crashes, right? So all I have to do is think about when the market's going to crash, and then I just buy this thing. What I didn't understand is how it actually worked, and that you're trying to thread the needle, like I said, on something that went from $2 billion to $2. Good luck. I don't want you in the wrong position. But again, I'm going to feel really low if you actually sell it because of everything I just said. And then next week we see VIX spikes to 60. That'll suck. Housekeeping. Oh my God, I'm in so much pain here. I don't know what's wrong with me. Housekeeping, small point. The volatility dashboard is missing a left heading between traders VRP and VIX index. Also had a bad date print on June 5th. Let me just give that a real quick look here. It's possible you're looking at the wrong thing. I don't know. I'll show you what went out today. This is today's email. Oh, I see. Oh, that's weird. It's staggered a little bit. So this is the volatility. Everything should be shifted upwards. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 1, 2, 3, 4, 5, 6, 7, 8. I see what you're saying. Okay, I will fix that. That is odd. I've never noticed that. But you know what I always like when people tell me that the things are wrong in the email? It means you were paying attention. So good job. Good for you that you noticed that. It means that you're actually checking the barometer every day. I like that. All right. All right. I know you've done a lot of work on skate to where the puck will be on volatility ETFs. Yes, that's referring to the old Wayne Gretzky thing. Don't chase after where the puck currently is. Skate to where you think it's going to be. That's what we're doing with volatility trading as well, because VXX today, that's not going to be the VXX 2 weeks from now. Whereas Apple stock or the S&P 500, yeah, it can go up or down. Well, unless something seriously changes in the market, VXX and UVXY are going to be lower in 2 weeks. So skate to where the puck's going to be. Have you done similar explorations with chronically decaying leveraged non-vol ETFs? I used to. About many years ago, I used to do a lot of pairs trading. I spent about 3 or 4 years doing that, with the 3 times leveraged oil ETFs. And, you basically short them both and ride that down. And one of them sometimes one of them loses, but the other one makes even more. I used to do that a ton, but I ended up running into some issues. I don't know if it's broker related where I was at the time, Interactive Brokers, but sometimes you just get your shares called away at a really bad time, and it really messes with your trades. And of course, then you have to pay fees and borrow fees, and they're not always available to short. The best times to do it is at the spike, like a peak of a spike. You can actually get in, short them both, and ride them both down. But that's actually when it's most likely to get called away and least likely to have shares available. So I kind of stopped doing that many years ago. But I kind of know what you're after there. Of course, there's arbitrage situations, and there's always opportunities when you get leveraged products because we know what's going to happen to them, right? The key is to understand how to sidestep the risk. Everybody knows that if you short VXX or UVXY, 80% of the time you're going to make money and you're going to feel like a genius. Everyone in the world can be profitable shorting these products for a certain period of time. The key variable is, can you manage the risk? Because it's going to rip your face off. So if you don't know what you're doing, you're going to feel like a genius for many months in a row, and then you're just going to get obliterated. So there's money available on the table for all of these leveraged products. It doesn't have to be volatility. For example, the Volatility Shares company has released it actually didn't launch. It was supposed to launch today, but I think it was pushed a week. But they have a Bitcoin ETF coming. That'll be interesting, right? I'm going to dive into that one in the next few weeks and just see if there's anything glaring that we can actually try to capitalize on. You can see me squinting and feel like crying here. Could you please clarify what intraday time and data source is being used for the values reported in the daily dashboard? I'm trying to follow along and manually calculate the metrics. Continued. Let's continue. But I'm having trouble consistently finding the price that matches your reported values. So essentially what I do every day is very consistent and it's the same. So let me pull up the email just so you know what you're looking at. So all of these values that I post, volatility barometer, cash VIX, what I do, markets open 9:30, right? I don't input any data for the first hour and 15 minutes or so, hour and 10, 20, I don't know. It's very close every day. because the first hour is very volatile and it doesn't give you very good readings. Sometimes there's reversals and you don't want that data. So I wait about an hour and 15 minutes and then I input the data. So everything you see here is calculated based on roughly, let's say 10:40 in the morning. That's when these numbers are coming from. And then they're posted in the email. But what ends up happening is at the end of the day or next day, I update tomorrow's values and I update the previous day's values to reflect end of day. So the value you see on the volatility barometer today is 3167, right? Tomorrow, I'm going to get the new value at 10:40 in the morning, and I'm going to update the previous day's value, which will almost certainly not be 3167. It might be 3132. So if I were to give you a list of all of my data points, they would be different, slightly different than the ones you see in the email. So I basically show you the right before I send the email, that's what the data is showing. And then because we have good, robust data for end of day and not a whole lot for intraday, in the future, when I'm adjusting my strategies and doing work optimizing, it's not useful to look at intraday values because I cannot cross-reference them with anything. I can have end of day, and sometimes you can get open and high and close, but intraday is not useful for me in my data mining for the future. So I like to have everything marked at end of day prices. So you are seeing essentially the most up-to-date values right before I send the email, right? That's how it works. And where you get them, I mean, VIX Central, SIBO, you can get it from Yahoo Finance, you can get it from stock charts, you can get, I mean, a million places. I get it from my Thinkorswim platform. Yeah, it's data is data. It should all be accurate. This is 2023. If you're getting bad numbers now, I don't know. It's probably not a good source. All right. Oh God. Can you comment on the IWM Condor getting closed out, as you said, by price blowing through our stop price? You were going to comment in a blog, but I must have missed it. So I did you one better. I actually made a video. So what I did is, you can see here, I closed it. Oh, did I close it out? No, I didn't close it out. So you can see how I staggered these lessons. This is the 30 video Iron Condor course. Lesson 28 is going to be called Let's Talk About Gap Risk, essentially is what it's going to be. And yes, instead of writing an article, I decided to just go ahead and make another video. So this is our current IWM Iron Condor that we have open now. It's doing fine. It was actually dangerously close to stopping out a few days ago, and then it's retreated back. So that's nice to see. But I'll just super briefly explain what gap risk means. Let's say, here's the price right now, right on that hash line. Let's say the stop loss is right here, right? So you're close to it, but you're not quite. And then you're thinking, well, you know, I like to be an analytical person. I'm not going to close it out because it's close. It's not there yet, so it's not there yet, right? Leave it open. Go to sleep at night. Wake up the next day. What happens? Insanely good market news. Market's up 3%. You might find that the price blows past your stop loss. So this is what we're talking about with gap risk on Iron Condors. If you imagine what happens on a profitable trade, let's put these back. Let's say the price is right there in the middle and it's a profitable trade. You are essentially just capitalizing on the theta decay. You're going to make $9 a day and it's going to trickle up there. And eventually you're going to hit your 50% stop gain, right? Remember, we use a 50% stop gain and a 50% stop loss. And nearly all the time on your stop gain, it's going to be roughly 50%, maybe 52, 53, but it's close. On the stop loss side, we are trying to get out at 50%. Most of the time we do, 52, 53, it's fine. But you do have to understand that when you're trading Iron Condors, and this applies to everything, not just Iron Condors, all of your option trading will have gap risk. You might get to that point where you are kind of feeling like you're super close to closing it out, but let's give it another day because it's not quite there. And then you're subject to what the market does. The market might just give you a really rotten day and it might just blow right past your stop. So what you have to understand is when you use a 50-50 stop, the reason we're doing this is because on the gain side, we like to churn a bunch of trades. And I don't want to wait 70 days until it expires. I can get half my profit in 20 days. I'm not going to wait the other 50 to get the other half, right? It's inefficient. You want to utilize your capital well. So I use the 50% stop gain and I churn a bunch of trades. The stop loss is there because I don't want to take a maximum loss. So we're trying to build a 50-50 situation, but the market has other ideas and you can't. So that was the first time that we actually got hit with a gap risk trade. It went, I think our stop loss was, I mean, if memory serves, I could be way off, but $2.08 premium rings a bell in my head. I think I closed my trade out for 263 or something. Like, it was significantly past. Now, fortunately, the strategy has many more winners than losers, and the performance is obviously just fine. I can actually show you the performance for everybody who's wondering what I'm talking about right now. I'm sounding like, oh my God, this guy just took a massive hit in his portfolio. Not really. I mean, this is the Iron Condor performance. You can see it here. There's an article on the website, Strategy Analysis. I basically did a periodic performance analysis. We did really well in 2020, so I thought I would kind of explain why that happened. We made 26% in 2022, or my strategy did. But here's where it is. So if you get the updated results next month, there's going to be a dip, right? You're not even going to really notice it. It's going to look like a little blip. But this is 2017 in August. Massive, brutal gap day. I think I lost 11% on that trade, and I was only supposed to lose 4. What happened there was it was on the other side. So maybe the price is down here. My stop loss is here. I remember I woke up the next day to something like a 4% crash in the market. It was just one of those uncanny periods where I was dangerously close to stopping out, and then boom, the market does this on you, and you're like, oh, I was supposed to stop out losing 112 and I ended up losing 600. That can happen. It's called gap risk. All option trading is subject to gap risk. All trading is subject to gap risk, but options obviously have the convexity and it can add up quickly. So hopefully that explained it, but there is a new video coming for you guys in the VTS community next week. 10-minute video explaining all the gap risk stuff, and comes with the territory. You hope that you have a strategy like our Iron Condors that is just mostly wins, and occasionally you get a gut kick. It happens. Hate it, but it happens. Okay, I left off there. Let's do this. I'm trying, folks. I'm trying to get through this. It's like breathing is the big problem. I should try to hold my breath. Do the daily metric percentile ranks come from a single date, or are they based on various dates? All right, I keep having to arch my back so I can breathe. What am I reading here? Do the daily metric percentile ranks come from a single date? Or are they based on various dates? I get what you're saying now. That's actually a really good question. Nobody's ever asked me that before. Essentially what he's saying is, because I rank everything, first of all, the barometer itself starts in January 2011, right? That's the start date, when we have the most robust data. For some of these, they've been existing longer than that. Obviously, the VIX futures launched in March of 2004, right? Some of these cash VIX values, we have the VIX 3M, and I actually have all of these except the 9D going back, decades. But the question is, are these all consistent? So yes, I have recently normalized everything to a start date of July 17th, 2006. That's the start date for all of these percentile rankings. Now, you might be thinking, wow, that's a really odd date. The reason I chose that date is simply because the publicly available data for the VIX 6M and the VIX 3M goes back to July 17th, 2006. So I thought, you know what, if people are trying to replicate my work and follow what I do, I could probably help them out a little bit and normalize everything to go back to a date where if you use that date, July 17th, 2006, you should have enough data to match everything that you see in the emails. Fantastic question. I love that. Again, I love hearing these because it means you're really paying attention. Hurt my back when lifting in my 20s and it caught up to me. Yeah, well, I went to the gym today. That's how it happened. I wasn't doing anything stupid either. I got home and I was fine when I left the gym, nothing, and it just every 10 minutes, it just got worse and worse and worse. And then, now I'm sitting here, I can't even breathe. Yeah. Sucks. I'm getting old, 48 years old. Body's breaking down. Had to give up squats, bent over rows, anything that put stress. Yeah, hurt my back since doing that. So I don't do squats anymore. I don't do deadlifts, of course. Deadlifts I call the back snaps. I don't do those anymore. That's just dangerous. Because when you get to a certain level of strength, right? A lot of people think, oh, well, deadlift, it's fine as long as you have good form. If you have good form, but you're pulling, 450, that you can still hurt yourself, right? It doesn't matter how good your form is. Some of our muscles can handle that weight, but some of them can't, right? So you get to a situation where, your large muscles are activated and you can pull that weight, but you've got these little joints and little tendons, and it's just your body's not designed to pull that much weight. So it's actually one of the things that the stronger you get, the more susceptible you are to injuries. And I'm at a point where, probably much like you, it starts to become a little bit dangerous when you're squatting significant weight. Like your quads can handle it, but can your joints, it's just not worth it anymore. So totally agree. As we get older, be careful. Obviously, any loading, twisting motion. Well, I'm a golfer. I'm trying to get back into golf. Like the whole thing is twisting motion. So I'm screwed. I just have to accept that I'm old and this is going to happen. Hold on a second. What is this? Oh, I thought you meant me. I thought I was giving off a vibe that I'm a really sad person. Like I said, this is a kind of a low energy live stream. I'm trying to just survive this one. The guy who holds UVXY is what you mean. Yeah, I feel your pain. Been there, done that. 2010. Don't want to do that anymore. No thanks. But you can see, it's going to be awful tough to time this thing correctly. And even when you do, what ends up happening is, this is the most heartbreaking part of it, is eventually the market does crash. Eventually UVXY does spike up. You see these massive spikes. But the problem is you've bled so much capital waiting for that date to happen that the thing triples and you still didn't get back to break even. That's typically what happens to people who go on the long side. So I don't look like I'm sitting funny, like I'm sitting like this. Thank you, but I feel weird. I think I'm going to put a pillow right on my back and go to sleep. I bought a lot of UVXY at 320. Should I sell it before the split or hold? Will I lose value if I hold it past the split over this month? So I don't know if you showed up before or after my presentation. I don't want to go through the whole thing again, but essentially there's two components to this question, and I'm not telling you what to do here. I'm just explaining your question. Component number one is the reverse split does absolutely nothing to the value of your holdings. If you are holding at 320, it does not matter what's going on. You're not going to lose any net liquidation value before or after the split. Splits only, the price is going to go up 10 times and the share count's going to go down 10 times. You're not even going to notice it happened other than looking at the nominal value. So the second part of your question is where it gets a little bit dicey, because you're asking me, should you hold UVXY long? No. But again, I'm not telling you to sell it, because if you sell it and then the market spikes and the VXX spikes up, well, you're going to, email me a nasty email. But no, when the roll yield is this strong, I'll try to illustrate it exactly for you by using this picture of my volatility barometer. So this is actually counterintuitive, people think. But on this picture, low volatility is down here, right? This is when the market is completely stable and calm. High volatility is when everything is absolutely melting down. So if you were to ask the average trader, when is the highest probability of success when you're going long the UVXY? When you're buying long volatility, where on this chart should you do it? 9 out of 10 people are going to point to this low side. 9 out of 10 people are going to say, this is where you do it. Why do they say that? because they think they're going to be the contrarian who's going to time it well. Volatility is going to reverse. It's going to spike back up and they're going to make a lot of money. I can tell you, as somebody who's been doing this for 17 years now, and not for nothing, quite profitably, this is the time that you go long the UVXY. And I know that sounds counterintuitive. People are like, are you crazy? You're going to buy the UVXY? Yes. I don't even consider buying volatility ETFs unless we are in the volatility percentiles above 96. That's just minimum. I need to see that the market is in full meltdown range. Then I'm going to buy the UVXY. There's two reasons for this. Number one, you can capitalize on some follow through of the market crash. So if the S&P is down 15%, volatility is going to be in the high 95th, 96th percentile at least. I'm going to get into a long volatility trade, and I'm hoping that the market continues downwards, right? Makes sense. That's when you have the highest likelihood of timing a volatility spike when it's already halfway there, right? Obviously, that's very easy. It's just the very next day, it might just continue going up. The second aspect is, don't forget that volatility ETPs don't trade based on supply and demand. They trade based on the roll yield of the VIX futures. So right now there is, ad blocker. I'll try to do this without a visual. Right now there is significant headwind on the products. So it's just going to be decaying down every single day. But if you buy the UVXY when the roll yield is strongly negative and the VIX futures are in massive backwardation, if you're wrong and the market actually reverses and doesn't continue crashing, well, your trade sucks and you're going to lose some money. But that insulation, because of the fact that the backwardation is so extreme, it's not actually going to kill you that badly. So you get to jump into this long volatility trade at a time when it's very likely that it's going to continue going up. And if you're wrong, well, no harm, no foul. That backwardation is going to give you a margin for error. But what you're doing is you're jumping into the market right now during low volatility at a time when it's extremely unlikely the market's going to crash on Monday, right? 3 months straight, it's doing well. All of a sudden, we think on Monday it's going to crash. That's not a logical response, right? So the first thing is you're probably going to be wrong and you're going to bleed your capital. But secondly, if you're wrong, it hurts badly because right now the roll yield is just ripping money out of your pocket every single day. I'd like to put the odds in my favor, and I'd like to put the VIX futures term structure in my favor and only go long volatility when it is actually at those sky high levels. And I've had a lot of success doing that. So that's what I would say is you guys who you're on the long vol side of the trade oftentimes and you're emailing me and saying, what do I do? I'm down 50%. I mean, do I sell it now? Do I keep it? I always say the same thing. I can't tell you to sell, but I can tell you you're on the wrong trade. That's the best I can do for you. I don't want to be that guy that forced you to lose some money because miraculously on Monday the market did actually crash. I would feel bad about that, but no, the odds are terrible to try to thread that needle and go long vol. You're not going to win that game. It's your first, it's exciting. It feels a little bit scary sometimes, right? Like what's going to happen? Are the options going to screw me? Turns out not a whole lot happens. There's just a couple of those things you have to be aware of. Like I said in the presentation, you want to be aware that you probably do want to sell your position, right? That's the first thing. You want to close out your UVXY options and try to reestablish something in either the VXX or wait a couple of weeks in the UVXY. And the second thing is inefficiency of the share count. You might get cash settled for a tiny portion of your holding. But other than that, it's going to come and go and nothing's going to change. And I suspect, unless the market does crash and help out our friend here who's holding the UVXY, if that doesn't happen, we're going to see a reverse split again pretty soon. There was actually a kind of a back-to-backer there. Didn't happen right away, but it was pretty quick. So if you look at this, sometimes they do that, right? You get a couple of splits grouped together. And then, of course, here, this is 2020. This is COVID. But even here, the Volpocalypse event in 2018, that coupled with the Q4 2018 market crash. You're staring at my dumb face. I didn't even hit screen share. I do that sometimes. Yeah, so you can see here that splits kind of grouped together. 2016, 2017, just down, down, down every day. You don't want to be long that year. But then sometimes you do get those spikes that it takes a few years to split. I suspect we're going to see a 1-2 here pretty quick because this market is strong. And like I said, I'm not going to be the one to step in front of it. I am not a contrarian. I am a trend follower. I am somebody who believes that the trend is your friend. You know, if this was 2005, being a contrarian 20 years ago was actually a very good way to be an investor. 30, 40 years ago, exceptional way. These days, you're going to get killed if you're trying to be a contrarian. I haven't met somebody who's a profitable contrarian in 15 years. It just, the markets don't work that way anymore. As the saying goes, the trend really is your friend. So for all my UVXY trader friends out there, don't try to time it. Wait till the market crashes and then see if you can make some money going long ball. Calendar trades incoming. Should be. Somebody asked an interesting question because the last IWM trade that we opened was an iron condor. And somebody asked, you know, why wasn't that a calendar? Because the volatility barometer was 32% on that day. And I always said that 33 and above is iron condor range and 33 and below is calendar range. Technically speaking, probably we were a percent or two away there. It should have been a calendar, but I actually had a lot of follow-up questions on calendars. And I think what happened was our 30-part iron condor course doesn't actually introduce the calendar aspect until I think lesson, I don't know, 21, 22. I just think it's a factor of not everyone in the VTS community took the course, to be honest. So I did have a lot of follow-up questions like, what's going on? You opened a calendar. I don't even know what that is. And I had to tell some, quite a few people through email, well, I mean, you didn't go lesson 21 to 27. It's all over those lessons. But, you know, understandably, I'm not forcing people to take my course, but it's there for a reason. So I do have to be a little bit careful on opening calendars because there's a lot of people who have no idea what I'm doing, you know, what that is. People are going to get mad at me if I bail out now. I think there's only 2 questions left. Oh, there's only 1. There's none. Okay. I made it. So I'm so sorry about my back and my scatterbrain today and I'm just trying to breathe here basically. So I have to lay down. I'm an old man. I promise that next week we will have a better live stream. Apologies everybody, but it happens. I'll be more careful in the gym next time. So thanks. And of course, next week there will be another one. And also next week there will be 2 new videos. So obviously subscribe to the channel down below. Doing a lot of volatility content lately, a lot of short VXX stuff, and there's more coming. So thank you, everyone.